Welcome to Mind Your Money. I'm Allie Canal, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, the end of the de minimis exemption. Tariff exemptions for packages shipped to the U.S. worth under $800 are over. We'll break down what it means for your purchases. And all things refinancing. We talk about the growth of cash-out refis and answer the question, how soon can you refinance after buying a home? Plus, retirees' out-of-pocket healthcare costs are spiraling. We'll bring you strategies for savings in retirement. A shipping loophole that lets small packages come into the U.S. tax-free is about to end. So how will that hit your wallet? Yahoo Finance senior reporter Emma Ackerman is here to break it down. And Emma, we're talking about packages under $800 here, but still, when you look at your online purchases, it's probably the bulk of your purchases. So what should shoppers expect here?
Absolutely. If you shop online, you have benefited from the de minimis exemption, whether you realize it or not. About 4 million of these packages that qualify under $800 are coming into the U.S. every day. So the exemption itself has existed since the 1930s. It was initially meant to cover packages that were almost so small it wasn't really worth regulating them or trying to collect revenue on it. Now, since 2015, the exemption has raised from $200 packages to $800 packages, which has sort of ushered in this rise in e-commerce. And the Trump administration is kind of looking to cash in on that. So since May, the de minimis exemption has actually been closed for China and Hong Kong, which is where the majority of these packages were coming from. And that impacted retailers like Shein and Temu. Now it's coming for the rest of the world.
Rest of the world. So how about small businesses and some of those other retailers? What's the ripple effect that we could see?
I mean, the tariff environment hasn't been easy for any business, but it is definitely going to hit smaller businesses harder. Bigger retailers might be able to eat some of these costs and avoid passing it on to the consumers and turning them off, while smaller retailers might not have the margins to make that kind of decision. One thing that I've seen is brands communicating to customers in the past couple of weeks that they really can expect costs to rise. Some of them are having sales to try and push inventory out the door. One thing that I think it's important to note is many of these brands had initially thought they'd have more time. In the One Big Beautiful Bill, it was mentioned that the de minimis exemption would end by July of 2027. Now it's ending, on August 29th. So that means that brands that thought they might have had a few years instead had a few weeks to prepare.
Wow, so what will this do to prices on the shelves and also online? Because my immediate thought goes to Amazon.
Right. We know that so far, with the de minimis exemption both ending for China and Hong Kong and broader tariffs more widely, we haven't seen that much tariff pass through in inflation. This could help speed things along. When you're looking at country by country, what you might be seeing product by product, you're looking at tariffs of 10% to 50% if you're talking about Brazil. And I did talk to one shoe manufacturer that actually makes all of their items and ships them from Brazil. So if you're buying, say, blazers from Japan or shoes from Portugal, you're looking at a different cost depending on which country it's coming from.
All right, so any tips for consumers thinking about their holiday shopping or their back to school shopping? Should they be rushing to purchase some of these things?
You may have seen, if you've been following the headlines this week, that a number of global shippers have decided to pause shipments to the US temporarily because of how much chaos this is causing. So you definitely should expect delays, and that may make it so that you want to get your online orders in a bit earlier. One thing that you could also probably expect is fewer choices. Brands may want to make safer bets on stocking products that they know consumers like, rather than taking risks on things that they might not, that might sit in warehouses.
All right, and I hate delays on my online ordering, but this is a reality that we have to deal with. Emma Ackerman, appreciate it. Thank you so much.
Thank you.
Well, new data shows mortgage originations jumped in the second quarter to their highest level in nearly 3 years, driven by both purchases and cash-out refinances. Cash-out refinances made up 59% of all refinance transactions, and 70% of those borrowers took on higher rates to tap their home equity. Yahoo Finance senior housing reporter Claire Boston joins us now. So Claire, let's start with the basics here. How do cash-out refinances work?
Yeah, so a cash-out refinance is pretty much any transaction where you are trying to to tap your home equity. And what you typically will do is you will refinance your mortgage into the prevailing rate, take advantage of any equity gains that you've seen in your home, and then basically start your mortgage over. And so depending on when you got your mortgage, your rate may change. If you were like one of those lucky 3% mortgage people and you want to cash out refi now, you're probably going to pay today's prevailing rate, which is about 6.5%. That being said, if you have a 7% mortgage, you could also lock in a little bit of savings at this very moment. Just really depends on your situation. And I will point out that right now mortgage rates are averaging about 6.56%. That is the lowest we've seen since last October. So maybe a little bit of an opportunity here depending on what rate you had to start.
And for those who are considering these cash out refinances, what are the pros and cons?
Yeah, so rate is a huge thing that matters. A lot of people really want to keep that low rate and that low payments, but a lot of people cash out refi to pay down other debts. Credit card debt is super, super high right now. A lot of people really felt the pinch of inflation. And the rates on credit cards, we're talking 25, 30% in some cases. And so, a lot of mortgage loan officers will say, hey, let's look at what we call the blended rate on your debt. Is taking a 6.5% cash out refi going to give you cash at a lower rate that then you could use to pay down all those credit cards? Auto loans also very high right now, and those are kind of ways that people can really lower their monthly payments depending on their financial situation.
So talk to me about home equity, because that also hit a record in the second quarter.
Yeah, definitely. So this is really a continuation of that trend of home prices continue to appreciate in about half the country, and the run-up in prices has just been so huge in the past 5 years that pretty much anyone who has owned for more than a year or two is sitting on a really, really big chunk of equity. Yeah, it is $17.8 trillion nationwide. And a lot of those people, maybe they want to pull some of it out at this time. And so that's kind of what we're seeing right now.
All right, Claire, keeping all the information clear for us on the housing market, which can get very confusing. Thank you so much, appreciate it. If you recently got a mortgage but aren't satisfied with the interest rate or terms, you're probably wondering if you can refinance it right away. The short answer is it depends. Here to explain is Yahoo Finance's Laura Grace Tarpley, lead editor of mortgages. Laura Grace, thank you so much for being here. Can you take us through the rules for refinancing each type of mortgage, starting with the loans most people have?
Absolutely, Allie. So the amount of time that you need to wait between buying a house and refinancing your mortgage depends on two things: the type of mortgage you have and the type of refinance you want to do. So there are three main types of refinancing. The first is a rate and term refinance, which is what many people think of as your standard refinance. You replace your old loan with a new one that has a new interest rate and new mortgage term. The second one is a cash out refinance, which, as Claire was talking about, means that you've built a lot of home equity, you tap into that equity and use the cash for other purposes. The third is a streamline refinance, which is a lot like a rate and term refinance, except you get to skip things like a home appraisal and providing certain documentation, which can save you time and money. So let's look at the type of mortgage that most people have. A lot of people have what's known as a conforming conventional mortgage, which is what you might just think of as a regular mortgage. And similar is a jumbo loan, which is very similar to a conforming loan, but it's for more amounts of money. And so with both of these types of mortgages, there's no law about how long you have to wait, but your mortgage lender will have its own set of rules. Some will let you refinance right away. Others might impose a seasoning period of 6 or maybe 12 months. But if you don't want to wait that long, there is a way around it. You can just refinance with a different mortgage lender.
So how about for cash out refinancing? What can you tell us about that?
Yes, with cash out refinancing, there are different rules. For conforming and jumbo and FHA loans, you need to wait 12 months to do a cash out refinance. With a VA loan, you need to wait 210 days, which is just under 7 months. And USDA loans actually do not have a cash out refinance program.
And there's one more type, streamline refinancing. What are the rules there?
Yeah, with streamline refinancing, which again is like rate and term, but it's faster and saves you more money. Those are not available for conforming or jumbo loans. They're only available for FHA, VA, and USDA loans. So for FHA and VA loans, you need to wait 210 days from closing on your house to do a streamlined refinance. And for USDA loans, it's typically 12 months.
And with mortgage rates changing so frequently, how long after your most recent refinance can you refinance again?
Yes, so a lot of people don't know this, but the rules that I just explained for how long you need to wait between buying and refinancing also apply to when you refinance and refinance again. So to give a simple example, if you buy a house and then wait 12 months to do a cash out refinance, from the day you close on that cash out refinance, you would need to wait 12 months again to do another cash out refinance.
And when does it make sense to refinance your mortgage? Can you time it out or game it out in any way?
Oh man, trying to time the real estate market is tricky, dangerous business. It really depends on the person and your situation, as long as it benefits you financially. So a lot of people don't know that when you refinance your mortgage, you have to pay closing costs again. And that typically comes to 2 to 6% of the loan amount. So as long as by refinancing, you save enough money to cancel out those closing costs over the long term, it could be a good financial move. So some examples of when it would be a good time would be if mortgage rates are down and you can lock in a lower rate and save money that way. Or maybe you want to refinance into a different term length. You could refinance into a 30-year loan to lower your monthly payments, or you could refinance into a 15-year loan to save money by paying off your mortgage a lot faster. So as long as it makes financial sense for you in one way or another.
All right, Laura Grace, great tips there. Thanks so much. And you can scan the QR code below for more mortgage content on Yahoo Finance. Coming up, retirees are struggling to keep up with healthcare costs. We have the story and strategies to save on medical care. Stay tuned. A new survey from Fidelity highlights just how expensive healthcare can be for retirees. Fidelity estimates that a 65-year-old retiring this year will spend about $172,500 out of pocket on medical expenses throughout retirement. That's up 4% from last year. And that figure doesn't even factor in the cost of long-term care. An assisted living apartment averaged more than $74,000 a year in 2024. That's according to the National Investment Center for Seniors Housing Care. For dementia patients, that price tag can top $94K annually. Fidelity's estimate assumes coverage under traditional Medicare Parts A and B, plus Part D prescription drug coverage, which includes premiums, copays, and other out-of-pocket costs. But many Americans aren't preparing for these expenses. Fidelity found that 1 in 5 have never factored healthcare into their retirement plans. For Gen X, it's even higher, 1 in 4. You can't stop the aging process, but with the plan, you can avoid the financial trap that often comes with it. Well, 20% of Americans have not considered how they'll pay for health care in retirement. According to Fidelity, let's talk about some ways that can get you prepared. Joining us now is Yahoo Finance senior columnist Carrie Hannon. So Carrie, you often recommend a health savings account or HSA. What makes this such a powerful tool, and what are some of the biggest benefits of using one?
Yeah, Allie, I absolutely do love these health savings accounts, and not everyone has access to them. But if you have a high deductible health insurance plan, which means that your premiums are a bit lower, but the deductible is higher, you qualify for these health savings accounts. And the beauty is you can put the money in tax-free. It can build up tax-free, and when you take it out, it is tax-free, and there's no minimum required distribution at some point, as long as you take those out for qualified medical health care expenses. Now, you can't put a lot in each year to these. It's around this year, it's $4,300 for an individual to contribute to these. But if you start early enough and use these, invest your money in these HSAs, they'll be there for you to cover your retirement costs in retirement in a way that no other, it's like the triple whammy, right?
Now, you write that most taxpayers don't let their HSA funds build up over time. Is that a mistake, though, Carrie?
Yeah, it is in many ways, but Ellie, the point is these were put together to help people pay for their current healthcare costs, right? So, people tend to use these accounts as checkbooks. And if it's possible to let that money stay in the accounts and stay invested in these accounts and roll it over year to year. It can be an incredible retirement savings vehicle to pay for these healthcare costs. The problem is, Allie, I don't think many people understand how these work yet. There's not a lot of financial education around the investment possibilities or giving people, employers, giving people guidance on how can we invest these like we do our 401ks. So I think that's something that we need to work on, but they are super powerful if they can be held in that account and rolled over year to year until you need those funds at retirement, because it comes out tax-free and you don't pay anything on those capital gains either.
Now, how about for people nearing retirement? How do you know if your savings are adequate? How much should you aim to have?
Oh gosh, this is such a tough one for people. And as you mentioned earlier, most people don't want to even think about this, right? So it's very nuanced. There's lots of caveats. How much you're going to need is going to depend, how much it's going to cost you is going to depend on your own personal health, right? How healthy you are, where you live in the country, because healthcare costs vary widely across the country, and how long you're going to live. We don't know. So there's sort of this crystal balling it. But the good number to work with is your healthcare costs are going to be one of the biggest expenses in retirement and your annual expenses. And that a good number is maybe 15% of your living costs each year. And so if you can put that into, as you start to do your financial planning with your advisor or what have you, think of that as a big part of your retirement budget. It's 15% of your annual expenses. And if you can start planning early enough, you can be sure that you have enough set aside to cover these out-of-pocket medical expenses. And this is, after Medicare. So this is something that most people they think Medicare covers all, but in reality, that's not the case.
Carrie, thanks so much. Appreciate it.
Thanks, Allie.
It's time now for our weekly segment, Ask Yahoo Finance Anything, where we answer your viewer questions on air. This week we have Bob Powell, the host of Decoding Retirement. That's our podcast on Yahoo Finance. And Bob, this time you did something a little different. You shared a list of common questions you receive all the time, and they range from cybersecurity questions to student loans, retirement. Let's jump in. First question here: how can I protect against identity theft, given that my Social Security data was potentially put at risk after Department of Government Efficiency officials uploaded sensitive information to a cloud account without proper oversight?
Yeah, this is the big worry that I've got this week because of the news. So 2 critical actions that you should take. First, check your credit reports from all 3 major bureaus. That's Equifax, Experian, TransUnion. You're entitled to 1 free report per year from each of these bureaus, and there's only one website that's authorized by the federal law to provide them, and that's annualcreditreport.com. Next, place a credit freeze with all 3 bureaus. This is your strongest defense against identity theft because it prevents anyone, including you, from opening new credit accounts until you temporarily lift the freeze. And the best part is that these credit freezes are completely free. You can lift them at any time that you need to apply for credit legitimately.
All right, question number 2. What do I need to know about student loans given the new One Big Beautiful Bill law? And this is definitely top of mind for most right now.
Yeah, so big changes are coming. For undergrads, actually, there is no change. You could still borrow up to $27,000 over 4 years, but parents face new limits. Parent Plus loans are now capped at $20,000 per child with a $65,000 lifetime maximum. Graduate Plus loans are eliminated entirely, but grad students can now only take out direct unsubsidized loans, which makes it a little bit more expensive for them. And then across all federal programs, there's a new lifetime borrowing cap of $257,600. We should also know that repayment has also been reshaped. There's now a new balance-based plan that ties your repayment term to how much you owe. And there's now a default option that becomes what's known as the Repayment Assistance Plan, or RAP. And RAP calculates your monthly student loan payment as a progressive percentage of your adjusted gross income, starting at $10 a month for very low income folks and scaling up to 10% of your income for people who have AGI over $100,000. And the last thing I'll mention about this is that all the old repayment plans will phase out by July 2028.
All right, Bob, question number 3. What do I need to know about Trump accounts?
So Trump accounts are new tax-deferred investment vehicles. They were created under the One Big Beautiful Bill Act. They're designed for children under 18. There's a special pilot contribution program for children born between Jan 1, 2025 through December 31st, 2028. Those children will receive a $1,000 government-funded pilot contribution, provided that they're U.S. citizens. Both parents have work-eligible Social Security numbers. Annual contributions in these accounts are capped at $5,000 from parents. I should also note that financial experts say that there are better options than these Trump accounts. Generally, they favor 529 plans for education savings because there's tax-free withdrawals and higher contribution limits. And they also say that these Trump accounts lack the tax advantages of, say, traditional IRAs or Roth IRAs. Still, they say these $1,000 government contributions represent free money that in essence are a no-brainer to accept.
All right, finally, who must take required minimum distributions in 2025?
Yeah, Ellie, this is a bit of a moving target. So if you're turning 73 soon, 2025 could be the year you must start taking RMDs. The starting age is now 73 for traditional IRAs, STEP IRAs, simple IRAs, and workplace retirement plans like 401k plans. If you already turned 72 in 2022 or earlier, you should already be taking RMDs. And then looking ahead, the RMD age jumps yet again to age 75 for anyone born in 1960 or later. You should remember that your first RMD is due for the year you turn 73, but you can delay it until April 1 of the next year. But delaying means that you have to take 2 RMDs in the same year, and that could push up your tax bill. One big exception that you should know about is if you're still working and you're not a 5% owner, you can delay RMDs from your workplace plan, but that rule doesn't apply to IRAs. And then lastly, remember that RMDs don't apply to Roth IRAs during your lifetime.
All right, Bob, some very helpful answers to complicated questions. Appreciate it. Thanks so much. Well, that's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter and stay tuned for Market Domination that's coming up next.